So today, what we want to do is give you a better understanding of a growing trend in the industry, direct indexing. We'll spend some time covering what it is, what it can help solve for, and what types of clients it's most suitable for. We want you to leave today's call feeling both comfortable and confident when speaking to your clients about direct indexing, knowing too that Parametric is here to support those conversations. So today I'm joined by Brian Langstrat and Tom O'Shea. Brian is the CEO of Parametric Portfolio Associates, and Tom is the Research Director for Managed Accounts at Cerulli. In August, Cerulli published a white paper on the topic of direct indexing called Improving the Client Experience, Customizing with Direct Indexing. In it, Cerulli estimates that growth in the direct indexing space will be 12% on an annualized basis over the next 3 years, outpacing both ETFs and mutual funds. And while there has been some recent hype around direct indexing, it doesn't seem to be just a fad. It feels like something we should all be paying attention to. But with asset managers, wealth managers, fintech, and others all claiming to have a direct indexing offering, it seems like direct indexing can mean a lot of different things to different people or providers. So Tom, what is direct indexing really? And how does it compare to the beta mainstays like index mutual funds and ETFs? Tom, you're on mute.
Sorry about that. I think we would have figured that out by now. Yeah, so you can think of direct indexing as having three main characteristics. It's a separately managed account of individual securities that, number one, seeks to have beta exposure to the market, some passive exposure. In the case of equities, that typically means mimicking the returns of a particular index. Secondly, it's a customized portfolio. So after it's built around that index, the advisor and their client try to customize it for their own particular needs. And historically, this is meant for their individual tax situation, but it could be ESG, it could be some factor investing, some level of customization. And the third major characteristic is there's an algorithmic tool or some process that allows the client and the advisor to see how much the returns of the portfolio will deviate from that index, a tracking error, and to maintain that tracking error within a certain boundary that the advisor and the client and the asset manager agreed to. So those are the three main characteristics of a direct index product. And it's really been around for a long time, but often compared to index mutual funds and particularly index ETFs. And when you think about how tax management in particular has evolved across these three different product categories, we start out with index mutual funds. You know, they're relatively inexpensive, so they have a great benefit. But remember, when you buy a mutual fund, you're buying into embedded capital gains. You're essentially riding you're having a collective tax experience and a collective ESG experience or some collective experience. It's not customizable to you. Now, index ETFs have come on board. They're in many ways have certain improvements. They're less expensive. Somewhat better tax treatment in the sense that these are individual securities that do trade on an exchange on a daily basis, as opposed to striking a NAV at the end of the day. But you're still getting that same beta experience as everyone else in the ETF. With direct indexing, you actually hold the individual positions. So for an S&P 500 index fund, you might hold about a couple hundred positions. And the fees are still very low, but what you're going to get is, as those positions trade frequently, they're going to go up and down. There are going to be many more opportunities, for example, to harvest losses. So you're going to get a much more efficient treatment from a tax perspective than you would in a collective vehicle like a mutual fund or an ETF.
And from your perspective, what are some of the use cases for direct indexing?
Well, I mean, the number one you hear about all the time is taxes, 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 taxes. And as one advisor, several advisors have told me that it's a great way to sell this because no one likes to pay taxes. But the other thing you're hearing about is tax transition, which is something that's often overlooked. Advisors, you often don't get incoming portfolios that are all in cash. So to being able to transition out of positions in a way that doesn't really hit the client with a big tax burden is hugely important to advisors. And then an up and coming emerging category is environmental, social, and governance, ESG investing. And it's particularly among the young. All of our data really show that there's almost 100% greater interest in this type of investing among young people than there is against their parents or their older counterparts. So client advisors who are looking at generational wealth transfer are also starting to think about ESG and how to customize portfolios for ESG. And the thing about, if we go back to the mutual fund example, everybody's values are so idiosyncratic that it's often very difficult to capture them in the collective vehicle. So what a direct index SMA does is allow you to actually customize it to the client's particular ESG values.
Brian, is that how Parametric has been implementing that type of solution for clients? I know we've been managing direct indexing portfolios since, I want to say, the early 90s.
Yeah, with regard to both the tax dimension and the ESG dimension, I'd agree with Tom that those are the primary drivers of the interest in this area. They're both very powerful secular trends, but they're also powerful ways for advisors to connect with their clients and add value in ways that are maybe different from the traditional pre-tax total return. So, with regard to the ESG component that Tom just mentioned, it's a powerful dimension for us in that we can create ESG solutions that are very straightforward, maybe have the advisor and client select an ESG tilted benchmark or select an off-the-shelf screen or screening technique, or work with that advisor to create a custom bespoke set of screens and tilts that, as Tom mentioned, represent or reflect the particular values and impact issues that the client brings to the table. So a very, very unique use of that customization component that Tom mentioned.
Yeah, so let's get into that a little bit more on the customization. Obviously, direct indexing allows for, I'd say, I call it unbundled beta. So you're able to unlock these customization capabilities that are not found in the packaged solutions like ETFs or mutual funds.